Hello, everyone. Welcome to the Edgemoor Investment Advisors third quarter 2020 presentation on current market conditions and outlook. I'm Jordan Smythe, and I'm here again today with my colleague Gay Truscott. And of course, we're still working from home, which we've been doing since March. We're all safe and healthy at Edgemoor. I'm pleased to report things are going smoothly, and we've adapted well to this new way of working and serving our clients. We're still available by phone, email, and Zoom. And we look forward to the day when we can meet you again in person. We will return to working together in our offices when we can do so safely. We hope you are also safe and healthy in these strange and challenging times, and we appreciate your joining us now for this presentation. I'm going to start us off by providing an overview of the stock market's continued recovery in the third quarter. Gay will then discuss our outlook and thoughts on our portfolios, and I'll wrap things up by sharing some thoughts on the impact of the presidential election. The summary of our current view on the markets is that we remain optimistic that over the long term, the U.S. and global economies will survive the current challenges and return to steady expansion, which is what we were seeing before the pandemic hit. However, our near to intermediate term outlook is more muted due to our concerns about the ongoing effect of the pandemic, including the second wave that seems to have started last month, and the heated battles for Congress and the White House that will hopefully be settled in about 3 weeks. Let's start by just acknowledging how much our world has changed since February, before the COVID-19 pandemic began its spread over the United States and elsewhere in the world. Since then, we have significantly altered our daily lives. Schools have shifted to remote learning. Millions of workers have adjusted to working from home or lost their jobs, and the stock market and the economy have taken us on a wild ride. The pandemic has caused great human pain, suffering, and loss, and it may be a long time before our world returns to its previous state. We're now living with great uncertainty, and we hope that this discussion can help us all see our way to a return to normalcy. Stocks continued to rise steadily through July and August. As you can see here on this slide, they hit a new high on September 2nd and then fell back almost 10% in early September before correcting to end the quarter. For the quarter, the S&P 500 index returned 8.9%, including dividends, and ended September up 5.6% for the year. As you can see in this longer-term chart, stocks are again trading near their all-time highs. Unfortunately, new cases of COVID-19 surged beginning in September in the United States and abroad, as many epidemiologists had predicted. The green line here represents new cases in the United States, and you can see the rise that began last month. These lines at the bottom represent various European countries, Russia, and a couple in Latin America. You can see a similar rise in most of those countries as well. Fortunately, cases in India and Brazil, represented by this line, have declined. The return of students to college was one of the reasons for the rising cases, and in the U.S., the disease hit the Midwest and the Mountain West particularly hard. Reports during the third quarter confirmed the dramatic economic impact on the restrictions of activity resulting from the pandemic. Second quarter GDP declined 31.4% after dropping 5% in the first quarter, and corporate earnings fell 32% in the second quarter. We don't yet have reports on third quarter GDP and earnings, but estimates are for GDP to rise sharply from the second quarter's low level, while corporate earnings will still be depressed compared to the prior year. Businesses hired during the third quarter, but they brought back fewer workers than in the second quarter and slowed the pace of hiring each month, as you can see here in these last three columns of the chart. This hiring caused the unemployment rate to drop to 7.9% after peaking at nearly 15% in April. However, even after the recent additions, more workers have lost their jobs than in the 2008-2009 financial crisis, and only about half of the 22.2 million people laid off or furloughed in the early days of the pandemic have returned to work. As it has since the onset of the pandemic, the U.S. Federal Reserve remains steadfast in its commitment to supporting the economy and revised its policy to allow inflation to rise for longer before triggering a Fed move to increase interest rates. Meanwhile, though, disagreement over the size and details of another stimulus measure has prevented Congress and the White House from offering additional relief that we were hoping we would have seen by now. I'll now turn the presentation over to Gay for a discussion of current conditions and our outlook.
Thank you, Jordan. I'm going to share with you some of our current market observations, our outlook for the remainder of 2020, and the implications and actions we are taking for client portfolios. Although many parts of the global economy are still struggling to recover from the COVID-19 pandemic, economic conditions here in the U.S. are starting to improve. As Jordan said, the U.S. unemployment rate is down by about half from its April peak, and U.S. GDP is expected to rebound in the third quarter from its significant decline in the second quarter. But of course, many pandemic-related risks remain, namely the threat of a second wave and possible lockdown as we enter the winter flu season. Even as cyclical recovery appears to be underway in certain sectors of the economy, the path and pace of that recovery is likely to be uneven. Specifically, sectors like technology, home improvement, home building, as well as online retail seem well poised to continue to prosper. But others, like travel, entertainment, and restaurants, remain vulnerable. The stock market's resilience amid these continuing uncertainties has been a bit surprising, although we know it has been driven in large part by the U.S. Federal Reserve's continuing support of the economy in maintaining low interest rates, potentially through 2023, and promoting market liquidity through ongoing purchases of Treasury and corporate debt securities. Moving on to our outlook, as I said, we continue to have a muted vision of the market over the remainder of this year. Parts of the U.S. are once again having difficulty controlling the spread of COVID-19, and the rehiring of furloughed workers, as well as the pace and impact of reopening of schools and businesses, remain uncertain. An interesting statistic I recently read is that until office reopenings surpass 50% in the U.S., in D.C., to put it in perspective, we're currently at around 25%, and most other metropolitan markets are in the 15 to 30% reopening range. So again, until that 50% mark is hit, the recovery of urban businesses, retailers, and even housing is likely to be anemic. As a result, it is likely that U.S. GDP and corporate earnings will remain constrained in the fourth quarter, though we do hope and expect a recovery to take hold in 2021. And of course, the uncertainty around the November election. For instance, will there be a clear winner and loser? Or will we face a protracted legal fight, or even worse, civil unrest? This uncertainty, combined with Congress's inability so far to deliver a needed stimulus package for workers, businesses, and municipalities, remains a significant overhang on the economy. So all in all, we believe the stock market will remain volatile until many of these uncertainties are resolved and the real prospects for a vaccine become clearer. In terms of portfolio implications and actions, we continue, as I said, to take a cautious stance towards the market. But we do have confidence in our nation and our markets to recover from this pandemic and resume growth. We have been identifying some attractive new investment opportunities and are redeploying cash cautiously. For the income portion of our portfolios, we are also being cautious and currently favor less volatile securities like bonds and preferred stocks. Overall, we are sticking with our long-term buy and hold investment strategy because we continue to believe that high-quality companies with durable business models and sustainable competitive advantages like the ones we own will survive this temporary threat and deliver solid long-term returns to patient investors. So now more than ever, we believe that our approach to active management, selectivity, and patience are the keys to long-term investment success. Before I turn it back over to Jordan for closing comments, I wanted to share a thought from a friend which I think perfectly sums up the year 2020. Oh, what a decade this year has been. Thanks for listening, and now I'll pass it back to Jordan.
Thanks, Gay. I'll close with some comments regarding the upcoming presidential election. Many people believe the performance of the stock market varies depending on the party of the occupant of the White House. We get asked about this a lot, particularly, as you might imagine, with the election coming up. What you see in this chart, though, is that the stock market has risen steadily over the long term, and even looking at just the tenure of each president, stocks have performed well under both Democrats and Republicans. There are differences in policy priorities, but we believe there are more important factors than who is president when it comes to stock market returns. That's it for now. As Gay noted, we remain confident in our investment strategy and long-term focus. We're monitoring these issues we discussed with you today very closely, and we'll continue to adjust our portfolios as we see the need and the opportunity to do so. Thank you for taking the time to join us. We hope you enjoyed this presentation. We welcome your questions, comments, or suggestions as always, and we hope you stay safe and healthy. Take care.